Hey everybody, welcome to this free edition of our Trader User Group Weekly Roundup for the trading week ending February 28th, 2025. We bring February to a close and move into March on Monday. I'm Preston Brand. Thanks for tuning in. Well, you can see up here, volatility's higher, equities down a lot lower, and risk is certainly off in the markets right now. Let's take a look at this past week and just kind of see how things are shaping up when we go to the charts here. If you'll notice, the only index that was in the green this week was the Dow, okay? Adding to their year-to-date performance versus all the other major indexes, Nasdaq recorded its worst weekly drop this week since early September of last year. Tech stocks, especially the Mag 7, declined amid a lot of ongoing regulatory uncertainty and concerns with multi-year AI-fueled rally losing its steam. The other thing that kind of popped up this week was tariff fears kind of continue to be a drag on equities as Trump reiterated his plans to impose new levies on several trade partners next week, March 4. So we got to be very careful with this market. Even though we finished strong on Friday, it wasn't really enough to move the equities into the green, of course, except for the Dow. And the highlight of the week's economic calendar really kind of came when the Labor Department released their PCE, that's personal consumption expenditures, Friday morning. I mean, the Fed's preferred inflation gauge showed prices rising year over year, but only at a 2.6% annualized rate. Again, this is the Fed's preferred gauge. And the prior month was at 2.9. Everybody was expecting 2.6. It came in at 2.6, so that tended to help the markets out early on in the trading day. Okay. In their report, it also noted that personal income rose 90 basis points in January. So we're seeing some contraction in consumer spending, showing that they're exercising a little bit of caution with persistent inflation and a little bit of uncertainty here. The other thing is consumer confidence. On Tuesday, earlier this past week, it fell 7 points. It's the steepest monthly drop since August of 2021, right? And then in other news, we got another pass at US GDP. It grew at an annualized 2.3% in Q4 of last year. And meanwhile, Treasuries posted positive returns heading into Friday. But generally, it was a very, the economic data is showing a lot of weakness across the spectrum. And then middle of the day on Friday, the Dow gave up 200 or 300 points and finished deeply in the red. Everybody moved down for about an hour or two on Trump's announcement of trade tariffs coming on March 4th. And then in the last part of the day, market price action reversed higher and then finished very strong on Friday. But with all of the machinations this past week, 2 weeks in a row of downside action on the markets, and we're not down that much, believe it or not. And you can see over here the PE ratio is down a little bit. The forward 12 months it's sitting at 21.62. Dividend yield is at 1.3. Treasury is about 290 basis points higher than the dividend yield, S&P dividend yield. That does tend to attract more money into Treasury. And earnings yield of the S&P is at 4.46. Okay, and if you look at the S&P yield over the 10-year Treasury, it's only about 25 basis points. That's hardly anything. A quarter of a point interest, quarter of an interest rate. 1% is what I'm trying to say. So it does tend to attract more money into the debt market. And then the current VIX finished up 7.8% from the prior week. Last week, it closed relatively high at 18.21. This week, we rounded out the week. Even with that big move into close on Friday, we still finished up 19.63%. So you got to be leery when markets are rising strong, even just short-term bursts of energy when the VIX does not come off of highs, okay? That shows there's still a lot of fear in the market. Okay. Now, if we just come over and take a look across the pond, you're going to see over there kind of a mixed bag in Europe. Euro stocks is down just a little bit, CAC 40 down just a little bit, but the FTSE and the DAX were up. Minutes from the ECB meeting that were released this past week indicated that most of the ECB policymakers, which is our equivalent of the Fed, meeting minutes, were confident that inflation's heading back to their 2% target. But then they said there's some evidence saying that it's a little bit sticky. So I'm not sure if they're going to be able to do as many interest rate cuts as they originally projected at the beginning of this year or late last year, but we're going to see, right? So outside of that, you can see the year-to-date numbers all across Europe are much stronger than the U.S., right? Now, keep in mind, Europe's been underperforming the U.S. for over a decade. So some of this is just a bounce and a play catch-up across Europe. In fact, some money is moving into Europe. It's been moving into the U.S. from Asia and the European markets into the U.S. markets. A lot of liquidity has been pouring in, but now we're starting to see money shifting to more value-oriented stocks and ETFs in the U.S. Okay. Now, of course, if we look at the Asian markets, all in the red for the week, in the red year to date, with the exception of Hong Kong, the Hang Seng. The Japanese market kind of retreated a little bit. A lot of it is domestic chip and AI related stocks kind of fell off after the sell off in US technology as well. And concerns are growing about the escalation of tariffs by the US, including an additional 10% duty on Chinese imports that could impact, believe it or not, some of the outlook for Japan's economy as well. Okay. And the Japanese currency, the yen, still had very strong gains in February. Now, I've been telling you guys, just throwing you some what I tell our members. I like the yen, upside on the yen, and I know for our members, I was suggesting going long the yen for most of late January into February, and you can see it when I show you the charts how it's been performing. Meanwhile, if we look at China, the markets fell in China. As you can see, they're down 1.72% for the week. Year to date, they're just barely in the red. Okay, Hang Seng had an ugly week, but year to date, it's up a little over 14%. Most of the week's declines for China kind of hit on Friday, and that was pretty much a day after Trump announced additional 10% levies on Chinese imports. So I can understand that. And he also announced 25% tariffs on Canada and Mexico starting next week. So we're going to see if he's going to follow through with that. And analysts are expecting China to reveal a fiscal deficit of about 4% of their GDP. That's a record high for China. And their consumer inflation target around 2%, down from previous year's 3%, is showing a lot of deflationary pressures are affecting the Chinese economy. Now, China is going to start next week with they call it their 2 sessions. It's an annual political event. And that's pretty much where President Xi and other party leaders come out and unveil their economic priorities for the coming year, right? And it's basically a lot of the analysts that are non-Chinese over here in the U.S. and Europe are believing that China is going to maintain a GDP growth target of around 5% for the 3rd straight year. So that's kind of a safe bet that they tend to put out there. All right, so what I want to do, I'm going to shift the screen over just a little bit here. Hang on just one second. And we're going to take a look at some of the major asset classes as well as some of the indexes here. So let me just shift this over like this, and it will take about 5 to 10 seconds on your screen, to kind of show where we are. And you're going to see which indexes are in the red year to date and which indexes are in the green. All right, basically Nasdaq, Russell, both in the red year to date. S&P is barely in the green. Dow is outperforming. If you look at the E-mini S&P 500 futures, you can see we were in the red at Thursday's close and Friday's close, and then it was that strong finish Friday that moved us back into the green. All right, the demarcation of being in the red versus being in the greens, 59, 38, 25. I highly recommend for those of you that you kick off New Year's, you mark that price level because it tends to be a price level that's a headline maker. The Rat Brain Business Journal of the day, the USA Today, the Color by Numbers USA Today, or the National Enquirer. Whenever the markets move into the red, that tends to be a headline number. Or when the markets move back into the green for the year, that tends to be a headline number. So it's it dramatically affects consumer sentiment. But you could see this big down move here. Now, if I were to just kind of take a look at the the percentage move is really not that big, right? I mean, it seems like it's a lot bigger than it really is. We're only down about 3.34% from the highs. Now remember, our correction's officially 10%. We're going to get a correction this year. I believe the odds favor that. I'm looking at sometime in May, June timeframe in the summer months. I'm seeing a bigger pullback. We may have a little bit of a bounce here, but be careful with this bounce. This is the kind of pattern that messes with a lot of people. You can see this bearish divergence here. It's just a beautiful bed on here. It triggered actually on the 20th of February, and I told our members, be ready for some downside. We did not challenge. We almost challenged, but not quite the lows for the year, which would have moved the markets down to these levels down here. This was my target early on right here. All right, and we hit the target perfectly. And notice that we did make new all-time highs, right, on February 19th. So the fact that we were able to make new all-time highs is now going to be a measuring tool to see, can we make these new highs, or are we going to come up and challenge short of this and then roll back over again? So we got to watch that very carefully. Okay. If we take a look at the Nasdaq, the composite index, not the Nasdaq 100 futures, look how far below the 50 EMA we are, and we made new lows for the year on Friday, and then we moved up strong at the end of the day, but you can see we're still well below the 2024 close, right? So the Nasdaq is down about 2.4% year to date going into the first trading day of March. Okay, there was no divergence here, and we did not make new all-time highs as we did in the S&P. The last all-time high we made in Nasdaq was on December 16th, when Nasdaq for that year of 2024 was up 34.59%. So this just tells me that we've got some profit taking, some risk off tenor of the markets, getting out of some of these. And if we come over here, and let me just move through this. You can see over here the FANG index, which is just basically a custom index I got here on Microsoft, Meta, Apple, Google, and Amazon, right? You can see here we moved into the red. We closed into the red just barely on Thursday. Friday, we moved into the red, and then we moved back out again. That candle there is a hammer, which does suggest some upside potential here. We've got some overhead resistance, but still, the FANG index, and if I were to just measure this just to kind of show you where we are right now, percentage-wise, it's down about 7.8%, 8%. So that kind of just gives you an idea of some of the money being taken out of the high rollers and the AI companies, right? And of course, if we come over and take a look at NVIDIA, which is kind of like the kingpin of AI, you can see here, and I don't have, well, it would help if I did that. Let's go in. So if we look at NVIDIA, it finished strong on Friday, but you could see if we just kind of measure it from the highs, which was right up at this level right here, NVIDIA is basically just top of the napkin. It's down about 17% from the highs, right, that were made back in middle of November of last year. So there's been a lot of selling going on in the AI leader, and after their earnings, you can see it just rolled right back over again. Okay. Now, if we look at the Russell, as I said, is also down. It's the worst year to date. And let's just zoom in. You can see the Russell was actually made new lows for the year, the end of February. And it's down year to date right now about 3.04%, but we still have, and it's also, by the way, it's below the 50 and the 200 EMA. So the Russell has been damaged, right? Big time. Right? So we're getting some of that pain there in the Russell. And then the other one I want to show you, let me just find it on here, is the Dow. The Dow is the best performer. You can see here the Dow is still below the 50 EMA, but it's well north of the closing price. So both Nasdaq and the Russell are in the red, and the Dow and the S&P is in the green, but just barely, right? So a lot of technical damage was done this past week to really move the markets. And then if I just come down here and show you the front month volatility skew, right? Because we always want to know what the skew is doing. It's in the red, so that means it's in a backwardation environment. That means near-term vol term structure is abnormal. That shows a little bit more risk in the markets. Not crazy, because if we go look at the back month skew, which is February, March volatility futures, you can see here it moved into the red during the day, but with that big move higher as we went into the last half of the afternoon on Friday, we're back in the green, but barely. So really the only vol term structure that's a miss right now is the near-term vol. And then, of course, if we compare in the vol term structure, April and September volatility futures, just to see where it is going further out in time, we're still in the green. So the term structure basically tells me near term as we go through March, there's still a lot of fear out there, okay? Near term fear. It doesn't tell me that the markets are getting ready to come unglued, just a little bit of sensitivity in price action. And of course, if we look at the 10-year interest rate here, you're going to see the 10-year interest rate made new lows on Friday. So now you're seeing the shift in the markets and the market sentiment. It was strong growth is going to push out the time when the Feds do their interest rate cuts for fear of driving inflation higher. Now we're seeing growth is getting weaker. The interest rates are moving lower. In fact, we had a brief period where the yield curve in the 10-year versus the 3-month T-bills moved negative, and that's the preferred yield curve gauge of the Federal Reserve. The 2s over 10, which is the 2-year note, our T-bill versus the 10-year note, those are still in the green, and that is also used for yield curve, but not as closely watched as the Fed's preferred 3-month over 10-year, right? So just all in all, the risk has gone up. Money is going back into debt, meaning the only way interest rates go down like this is money is going back into Treasury in a sign of safety. Okay. So the Feds, what I saw that was interesting is now you're hearing talk that maybe the Feds will be forced to cut sooner and more often to alleviate this slowing of the economy. We're going to need more economic data to get that. Remember, we did not have a Fed meeting in February. We will get one this March, and it is a quarter end. And at quarter ends, we get the dot plot where all the voting members, I think there are 12 of them, say where they see interest rates going for the forward 12 months. So that's a big number. We're going to get Boom Boom Powell talking about the tariffs, obviously, but also inflation, the stickiness of it, and the reduction in these longer term rates. It's going to be a very interesting meeting. Okay, that's coming up, I think, the third Wednesday of March. So we got to be on the lookout for that. Okay, and obviously, if we look at the 10-year note, all right, with interest rates down, people are pouring into the 10-year note. Look at that; it's moving up off of the close of last year. It's moving up, and of course, if we look at the 30-year, it's moving up as well, right? So when these move up, and I got to adjust this too because it's already made new highs for February, that moves interest rates lower. Okay, it just moves them a little bit lower. And then, of course, if we look at currencies, with a little bit more fear in the market, what does that do to the dollar? It gives the dollar a little bit of a bullish bent to it. You can see here the dollar made new lows back on February 24th, and now it's moving up. It recaptured its 50 EMA. So when in times of stress, money does pour into the US dollar, okay? And then, of course, if we look at the euro, it moves opposite of the dollar index. We're almost break even for the year on the euro, right? It's down around 103. My longer term target for the euro is down here, okay? Sometime in the summer months, I'm even calling for it to be possibly at parity. Okay, that would require the markets to come undone here in the U.S. for that, right? And remember, when you move into the negative with the yield curve, it projects a much higher probability of a recession 6 to 16 months out in time, about a year out in time. We had that same thing occur when we moved into a negative yield curve a couple of years ago, and some people say that we did have a recession in 2022. If you remember, that was our bear market. Some people said it was a recession, but the official gauge called it a non-recession because we had positive GDP. We didn't have back to back, but some people still felt that was a recessionary time with the bear market. So we got to be really careful here, guys. That's what I'm seeing in all these charts. And then let's look at gold. Even with that big move stronger at the end of the day on Friday, gold I believe is going to sell off any rally. I would sell the rally at least near term. I think it's going to come down and break the 50 EMA. All right, you can see the 50 EMA sitting at about 28.18. And we're at about 28.67 right now. So, you're looking at about 50 points or so lower from where we are right here. I think any rally, just going into the summer months, we could sell off. Remember, if you move into a recession or we have a big deep dive to the downside, the initial reaction for gold is to sell off because people are trying to make margin calls, and then that would be a buying opportunity. Is kind of what I would say about that. Okay, and then of course silver is going to be the same. It's got a little bit of a higher beta than gold. Notice silver is below the 50 EMA. That was my target over here. We hit it perfectly. This is an Elliott wave 3. It would suggest that it's a buy the dip. And my longer term projection for silver is a lot higher. So I do believe we got some mixed signals out here on both silver and gold, and the markets are just a little bit uh, um, discombobulated right now. And I think that's also apparent with the Trump administration. I told you guys the policies are good for the U.S., but it does create consternation in the near term as markets try and adjust to it. And of course, if we look at oil, I'm projecting lower oil prices, right? You can see here we hit a 25 low on February 26th, and I'm actually projecting oil to come down much lower. Any rally in oil, we're in the red year to date, should be sold off because I do see oil moving lower. Nat gas is slightly different. You can see here with nat gas, no bearish divergence right here. So any movement here, probably rally should be bought, but not yet. All right. I think nat gas can move a little bit lower, but just remember back over here, I was talking about selling nat gas, and back over here, anytime you get these spikes in nat gas, they're worth taking some shorts for a 1 or 2 week period just to play the swing trade in natural gas. Okay. All right, everybody, that's a really quick overview of some of the major asset and commodity classes. Members, I will see you Sunday evening. We've got a lot to talk about on these markets and just what some of these cross currents mean. Meanwhile, just be careful with these markets, folks, on any rally here. Just confirm that we're holding key levels and the volume is there to support the rally. All right, everybody, have a good ciao now.